India's central bank has reportedly taken a massive short position against the US dollar. Not just a record short, but smashing the previous record, and it isn't even close. Despite this, the rupee just hit another record low again today. And the reason for both is the same thing: globally synchronized downturn, one that is likely accelerating. I went over this a couple weeks ago. India's rupee is a global bellwether for perceived monetary and economic risk with a stellar track record. And with that in mind, no wonder the Reserve Bank of India is trying desperately to limit the currency slide. The official story is that officials are merely trying to reduce the rupee's volatility, but we all know that's BS. The latest data from the country fully exposes that lie. I went over India's increasingly precarious shape in a video on October 12th, and the information that's come in since then has backed up those concerns and then some. Today it was reported that GDP slowed down a full percentage point more than even the lowest expectation for it. Bank loan growth is starting to look a lot like what we see in China, only on an even more condensed descent. Since India has a shadow banking lending problem, the accelerating decline in that rate since the summertime has only increased fears of a potentially disorderly financial unwinding, leading to even more economic woes. And when you examine what those are, they sound exactly like everything that we see in the US or Europe. In fact, eerily similar to what I just talked about on Wednesday. Here in the US, as retailers struggle to sell holiday merchandise, American consumers can't really afford to buy. Those are the reasons why the dollar is pushing the rupee lower. As I said 6 weeks ago, the real danger, therefore takeaway from the rupee slide, is the combination of global conditions and those local imbalances potentially unwinding too quickly. And RBI's actions, both home and abroad, in shorting the dollar suggest that they're worried about all the same things too. That's the only reason why they would buck the buck to this degree. And when we see the dollar rise in this fashion against major currencies, that's not a good sign for anyone. So we'll start with what was reported from the Reserve Bank of India building up a truly massive US dollar short position. According to Bloomberg, the Reserve Bank of India has built up a roughly $60 billion book of net short dollar positions in the overseas NDF market. And I'll get to what that is in just a second. That dwarfs the official record of 19 billion net shorts across both onshore and offshore markets, which was set just a couple months ago in August. The trades represent a stark shift in approach by the central bank, which has previously focused more on taming volatility in its domestic market. That's the excuse they always give, and obviously it can't be that. The RBI's recent blitz of NDF trading means the bulk of its currency intervention is now happening overseas, offshore. The central bank's net short dollar position across both markets is around 70 billion, according to research by Barclays. The Monetary Authority has been primarily intervening in the 1 month to 3 month tenors via the Bank for International Settlements, at least according to these traders, adding that the RBI prefers to intervene before the local market opens. And the intent here by operating in the NDF market is to dissuade speculators, which is something, it's a tactic that central banks all over the world commonly refer to because they don't really know what else to do. It's the Eurodollar's world, and they're trying to manage their risks within inside of it. So what are NDFs, or non-deliverable forwards? Well, they're derivative contracts that, because India's current currency exchange markets are highly regulated, to put it kindly, they're very rigid and cumbersome. It's much easier for financial participants in India and elsewhere too to transact in an offshore environment. It's always offshore because that's where most of the business is. So whether it be London or increasingly the Middle East, instead of exchanging currencies that is difficult to do from an Indian perspective, you engage in a derivative contract. And as the name implies, you're not delivering actual currency. You're only delivering the differences in cash flows between expected values of those currencies. So if you're betting on the Indian rupee versus the US dollar, you don't have to put up, say, $1 million as the contract specification. You only have to put up the difference between the two values between today and in the future, which means a lot less, and therefore you don't have to actually get into convertibility and everything else. So it's not a funding market like other FX markets. It's mostly for speculators who are betting on the direction of either the dollar, the rupee, or some other currency involved in the marketplace. So you can see why the Reserve Bank of India would want to intervene more and more into that market if you believe, or if you're selling the narrative, or if you're just trying to influence the behavior of your currency value from the perspective of those who are So if there's a lot of speculators who are building up short positions on the Indian rupee, one thing that the Reserve Bank of India could do, because it has access to a lot of funds and resources, is to go into the non-deliverable forward market and screw everything up by taking the opposite side. Teaching a lesson to speculators in theory, telling them, don't you dare short the rupee, because we'll come in and short the dollar instead and buy rupees and blow you out of the water. That's the idea. By taking such huge positions in the NDF market, they can, at least in theory, dissuade speculators from taking the opposite side, shorting the rupee too much and forcing it to go lower. But that's not actually the problem. And it actually opens up another problem for the Reserve Bank of India, because at some point, after creating these massive dollar short positions, they have to unwind them in the future. And just so that we're clear here, they're not short the US dollar by 60 billion or 70 billion, as the number was thrown around in Bloomberg. That's the notional amount of these contracts. They're only exchanging the changes in exchange values over the period of the contract, whether it be 1 month or 3 months. But even so, we're talking about potentially being on the hook for losses if the dollar continues to go up, and losses that could pile up to several $1 billion, which is a lot in a marketplace like this. And it's a lot for even the Reserve Bank of India to justify, given everything that's going on, the fundamentals of the Indian economy and the Indian marketplace. So these are substantial short positions, and they're not having the intended effect. Plus, they set up the Reserve Bank of India to have to go in the opposite direction, because if you're shorting dollars today, unwinding that contract means you got to go in the opposite. You got to buy dollars to close it out on the other side. And if they don't do that, then they at least have to roll them over at potentially increasing and even skyrocketing losses. And it's, like I said, it's not effective. It's speculators aren't the problem. So they're essentially trying to, like Chinese authorities do quite a lot, to influence the direction of the currency through the lens of speculation, when it's not actually speculation. And despite the fact that the Reserve Bank of India has gone into the NDF market to this degree, the rupee just hit a new record low today, down to around 84.60 to the US dollar. So it's not enough to solve the dollar issues. And it really goes back to these fundamentals, as I keep saying, bad global economy, and the local one in India being impacted by, maybe negatively, by the shadow bank boom and bust concerns. And then we got all of the data that came in from GDP and the bank lending numbers, and it just adds more doubts and concerns and worries and risks that go beyond doubts, concerns, worries, and risks. Before we get into what the fundamentals that were reported, the data that came in, I do want to remind you, Eurodollar University, we are in the middle of a Black Friday sale that's only going to be good through Cyber Monday around midnight. We're offering 50% off our deep dive analysis, and if you take that deal, we'll even throw in a membership and a subscription to the daily briefing at no additional cost. That's the annual membership for the deep dive analysis. If you're just interested in a membership itself, that's 50% off of the first month. Same thing for the daily briefing, 50% off the first month. And also don't forget, we've got a live webinar coming up on December 11th where Jim Rickards and I will be going over the future of monetary systems. There's a link in the description for both the Black Friday, Cyber Monday sales, as well as the webinar on December 11th. So what was reported today from the Indian government was GDP in the third quarter of 2024. And remember what I said in the previous video, if you've seen it, the Indian economy had been, among all of its peers, really the rest of the world, the Indian economy had seemed to be invulnerable. Where everybody else has struggled the last several years, instead, India was legitimately booming. Now, there are questions about whether or not that was sustainable and what was really behind it, but India was actually moving along in a very good way compared to everyone else. But earlier this year, and really going back to last year, but earlier this year, some of the cracks in the foundations began to start showing, and concerns continue to be raised about a whole host of issues. As I mentioned, shadow banking, as well as what's really driving economic growth overall, the too much government spending, too much government waste. And so for the third quarter of 2024, suddenly the Indian government says, this is not slowing down much more than had been anticipated. India's economy grew at its slowest pace in almost 2 years, dampening the outlook for the full year and testing Prime Minister Narendra Modi's ambitious growth plans. Gross domestic product grew 5.4% in the 3 months to September from a year earlier, the Statistics Ministry said in a statement on Friday, that's yesterday. That's the worst reading since the fourth quarter of 2022 and much lower than the central bank's projection of 7% for the year. And none of the 44 economists surveyed by Bloomberg had predicted such a slow pace of expansion. And Indian GDP had been around 4.3% year over year during the fourth quarter of 2022, and that quickly accelerated throughout 2023 while Europe was falling into recession, Japan. 2023, India's GDP accelerated to 8.6% by the fourth quarter of last year. But starting out 2024, it slowed down a little bit in the first quarter, a little bit more in the second quarter, and now what looks to have been a pretty sizable stumble in the third quarter. And again, while 5.4% growth sounds terrific compared to where we are around much of the rest of the world, it actually, from where India was and where everybody was hoping it was going, that's a substantial change. In fact, you started to see a lot of similarities in India with 2019, which is the entire point for the dollar and its exchange value rising against the rupee and a whole lot of other places. Remember 2019, globally synchronized downturn there as well. And then the government also reported, the Reserve Bank of India also reported loan growth. Well, that was up 11.1% year over year here in November. This is a situation like China where you see these numbers and they sound huge. It's actually not as big and not as good as you think it is. That's slowed down tremendously from the summertime. Back in August, loan growth was rising at a 13.6% rate. And even before then, go back to May, loan growth was rising at nearly a 20% rate. So lots of indications of, like I said, the shadow lending bubble cooling off, though there are questions and there are interpretations that suggest that India here is just cooling down after a period of record and red hot economic growth during especially 2023. But that's where the markets come in. That's where the Reserve Bank of India's actions come in, suggesting that they're worried, the market and the central bank, that this is not just an economy that's cooling down. This is not just a system that experienced rapid loan growth because of sustainable fundamentals. On the contrary, this might be slowing down too much, too fast, the dollar going up too far against the Indian rupee too fast, simply because things really are turning in the wrong direction, globally synchronized too. And there was even more. Indian wages contracted last quarter for the first time since the pandemic, curbing the economy's breakneck speed as consumers cut spending and corporate profits slump. Inflation-adjusted employment costs for listed non-financial companies, a proxy for real urban wages, declined 0.5% in July to September from a year ago, at least according to data from Elara Securities. Consumers are now cutting back on everything from soaps to cars. Some of the country's biggest companies, from Maruti Suzuki to consumer bellwether Hindustan Unilever, they've posted weaker earnings recently, saying urban middle-class spending has been languishing. About half of the companies in the NSE Nifty 50 index missed consensus estimates in their second quarter earnings, according to data compiled by Bloomberg. Doesn't this sound familiar? It sounds like everything I just talked about in the US on Wednesday for Black Friday and Christmas holiday shopping here in the United States. That consumers are struggling because wages and incomes are not keeping up. So there is a high degree of globally synchronized in all of it. Not only is there local conditions and local idiosyncrasies, you've got things that are specific to India, like the shadow lending boom potentially bust, but it's within the global context where it sounds so incredibly familiar, like we've heard this before, because we have. It's the downside to the imbalances of the supply shock. And while India weathered it much better than other places had, in the end, they may not be as invulnerable as had been commonly believed. That's what the dollar keeps telling us, not just against the Indian currency, but as against the Indian currency, it applies to India as well as elsewhere. And that brings us back to the Reserve Bank of India. Not only are they shorting the US dollar to a massive record amount, they're also having to take steps inside of India and the banking system because of all of the spillovers related to that. The US dollar is causing enormous problems for India, and that's causing enormous problems for the Indian economy and the central bank at the same time. India's central bank has stepped up dialogue with traders at Treasury desks this week about cash conditions in the banking system, at least according to people with knowledge of the matter. Spurring speculation, it may announce some measures to boost liquidity at the policy review on December 6th. And while Reserve Bank of India officials routinely call traders to check on various issues, the focus of the recent engagements has been on how the liquidity situation is panning out amid large foreign outflows from stocks and bonds. Again, according to people who were asked not to be identified. So the rising, here we see, again, globally synchronized, the rising dollar, the impact that it's having, the Indian economy that's struggling anyway, then you throw in globally synchronized weakness on top. It's a recipe for what would have the Reserve Bank of India shorting the US dollar to a record amount, hoping beyond hope just to buy enough time that maybe the situation settles down. That's the common theme in all of these central bank interventions that we see throughout the world. So the RBI is fighting against Eurodollar problems. They're shorting the dollar, trying to dissuade speculation when speculation is not actually the issue. They say they're trying to control volatility, but at this level of activity, shorting the dollar in the NDF market, it's obviously more than that. They're getting a little bit more desperate because the situation is itself becoming more desperate. Weak global fundamentals plus having trouble brewing locally mean the higher risk of the rupee dropping sharply. And with the Reserve Bank of India short the US dollar as much as it is, it's actually creating more systemic risk that would lead to a more disorderly unwind in US dollar terms, but also higher charges from the Eurodollar system on the Indians' access to it. All at the same time, the Indian economy, the US economy too, the Indian economy is experiencing more and more visible struggle. The banking system, the shadow sector, all of it. More and more clearly defined struggles. It's all a toxic mix that adds up to exactly what we see in a lot of places around the rest of the world. The same types of behavior because it is, at the end of the day, globally synchronized. And as I've said before, the Indian rupee is one of the canaries in the coal mine in that regard, and it has been repeatedly throughout these Eurodollar cycles, really going back to the beginning of the 21st century. So as the rupee continues to fall to a record low, and the Reserve Bank of India does record amounts of interventions to try to stop it, it tells you about just exactly how much the Eurodollar system is looking at the situation around the rest of the world, as well as in India, and saying, I don't like what's going on here. If you want to see the history of how and why the Indian rupee is globally synchronized, check out the video I did a couple weeks ago. It's the one link below. As always, thank you very much for joining me. Check out Eurodollar University's Black Friday, Cyber Monday sale, the webinar, links in the description for both of those. Thanks to Eurodollar University members and subscribers, and until next time, take care.